Hi guys, and welcome to the first video in this three-part series. So what we're going to be looking at in this video is why discretion. So why is discretion so important? Now, a lot of people will overlook discretion and they think that it's something that's not necessary. It can create emotion or make you make mistakes, and it's simply not the case. Discretion is essentially your experience and your understanding of the market. It's super important. Now, even in rule-based strategies and stuff like that, there is going to be an element of discretion. You know, there just is. It's down to your experience and your knowledge, and we believe it's actually one of the most powerful tools that you can actually have in your arsenal when trading. So what we're going to do is look at a couple of examples on the charts and explain exactly why discretion is so important. So guys, you now join me on the charts, and we're going to be having a look at our first example here of why we feel discretion is important. So looking at pound CAD here on the 4-hour time frame, we're going to be looking at this from a purely SMC or institutional style trade. So what we can see is the market is clearly making higher highs and higher lows. We're clearly moving to the upside on that larger scale, looking at those major swings instead of these minor swings on the inside. Okay, so what we can potentially see is we are making a higher low here for that next push to the upside. Okay, so without using your discretion, and if you were treating this from purely a mechanical approach, a rule-based approach, this is what it would look like. So you'd see that we're making higher highs, higher lows. You'd assume that, you know, at some point in this area here, potentially we're going to make that higher low, right? Then we go down onto our hourly time frame where we can see things a little bit clearer, and I've actually just marked up a setup here. So what we could potentially see is we've waited for liquidity to be taken from these lows. The market's pushed down, taken that liquidity, pushed to the upside, broken our highs, and we're now looking to come back into that order block, mitigate that, and then go and push to the upside. So with a rule-based strategy, this is exactly what you'll be looking at. You'll have seen that you've broken liquidity to the lows, you've broken your highs, so naturally your last bearish candle is going to be your order block. So what people will simply do is put their order at the top of the order block, and they will put their stops just below. Or they may have the 50% of the order block. It may go down onto the lower time frames, etc., etc. But looking at this from purely just a rule-based approach, this is typically how people will do it, and they may just go and target, you know, above the highs over here. All right, so what I'm now going to do is I'm just going to play price action, and we'll have a look at how this plays out. Okay, so price action comes into our area of interest really impulsively there. We get tagged into the trade quite nicely, and then we don't really get that conviction push to the upside, and we go and smash straight through that level to the downside. So why was that? So the reason that that happened was purely down to a lack of discretion. So discretion comes in many shapes and sizes, many different forms, as we've spoken about. It's essentially your experience and, you know, your time and knowledge on the charts. Now, we know that when we have an impulse to the upside, you know, in this case here, we want to see a corrective fall back. So that basically creates the fact that, you know, we've had an impulse that gives us direction. If we get a slow corrective pullback, that kind of solidifies that there's no commitment from sellers, and we're going to see that next push to the upside. And the same if it was bearish. If we got a fast push to the downside, we'd want to see a corrective pullback and then that continuation to the downside. Now we can see we've had an impulse there. We haven't had a clear correction back into those lows. We've had a really impulsive, you know, bearish candle into that level, and that's why we've gone and pushed to the downside. So understanding price action is absolutely key. And again, this is an element of discretion. Now, if you don't account for this sort of stuff, if you don't account for your discretion and your understanding, and clearly understanding price action is a little bit too impulsive there, there's a pretty good chance it's not going to respect those levels. You are going to see poor strike rates. You are going to see losses. So it's very important to understand the price action into an area of interest. It's so crucial to understand that larger picture, that overall direction, and then that clear price action into an area of interest. So that's a clear example there of how that mechanical rule-based approach can actually hinder your trading and why discretion could have actually helped you there. So what I'm going to do now is show you another example of where we actually use our discretion and the trade goes in our favor. So guys, we now have our second example, and this time we're here on Euro Aussie dollar on the 8-hour time frame. So if we just scroll out ever so slightly, what we can see again is we look at this from a kind of a higher scale. What we can kind of see is, you know, the market is somewhat moving to the upside here, making higher highs and higher lows. And then what we can see is we actually have kind of an opportunity for a bit of an intraday move, that kind of shorter term play here. So what we can see is, if I just zoom in ever so slightly, hopefully you can see that okay. So what we can see is the market then pushes to the downside, we pull back and make a lower high. The market then pushes to the downside and makes a low, right? Then what we can see is the market spikes to the upside here. We actually gather liquidity from sellers in these areas. We then push to the downside, pull back and break the low to the downside there quite impulsively. As we can see, we've broken our low there, right? So what we can see is, again, there's going to be a reason behind that. There's going to be a reason to ask why those lows broke. And typically, in this case, it will be an order block. And again, don't worry if you don't know what an order block is. We do teach you exactly what it is, how to find them, and how to use them within our strategy as well. Now, again, when picking an order block, it uses your discretion. You have to use your discretion to decide which candle is going to be your order block. Some people will assume that the order block is all the way up here because that's where we took liquidity from. Some people may assume that it's that candle there. Some people may assume it's that candle there. So again, you have to use your discretion, your knowledge, your understanding to decide which order block to actually pick. Now, what we can see again is we've had an impulse to the downside. And just like on our previous example, we said that we wanted to see corrective price action back into that level. Now, we can clearly see that this price action here is corrective, okay? So that straight away, this fits our bill, this fits the plan so much more than that previous example. Now, yes, it is on a higher time frame. It is a different pair. Obviously, different pairs have different characteristics. They move differently. Smaller time frames are going to look slightly different to the larger time frames and all that sort of stuff. But you know, this is just a good example of how this actually plays out and how price action is so important, and how you do need to use your discretion to decide whether price action is right or whether you're just being systematic. Okay, this has happened, I'm now placing a limit. Whereas we can see this has happened, price is now corrective, so there's a better chance for that continuation, and we've still got our nice order block level in there as well. So what we can do is refine order blocks, and we can drop them down from the 8-hour to the 4-hour to the 2 hours to the 1 hour and so on and so on. And again, don't worry if that sounds like mumbo jumbo or it doesn't quite make sense, because again, we do teach you how to do that within the course and within the strategy and the community as well. So what I'm going to do is just play this out ever so slightly. And as you can see, this is nice and corrective at this point, nice and slow price action. Now, once we see prices here, we can start to look for an entry. Now, we have always traded patterns, price action here at TST, and there's a very clean example of a pattern here, as you can see. But again, don't worry about that at this stage, because again, we do teach you all the ins and outs of price action, patterns, all the different variations, the pattern separation, how to find targets with patterns as well. We teach you all of that within the course. Now, this video is essentially focusing on discretion and understanding price action into areas of interest. And again, it's so crucial. So for example, if I now just place my limit at the low of the order block, exactly the same way that we did it on the previous example. Again, there's a slightly large stop there. There is different ways we can enter here to get tighter stops as well. And let's just say we target lows down here for the time being. Okay, so that can be our first target. Now, what we can do is drop down to the 4-hour as well. We can see that, you know, exactly the same scenario. Price is definitely corrective throughout that whole pullback, that whole retracement. Price action is ascending and corrective, which is exactly what we want to see. So for example, if we see an impulse to the downside, we are then ascending. This gives us a great idea and identifies that we can go and push to the downside. However, if we get an impulse and we then start to become descending, there's a very good chance that we'll actually reverse. And the same if we are bullish as well. You can see the same thing time and time again. The market just repeats itself time and time again. And this is a definite way that we can incorporate order blocks, institutional methods to give it that better strike rate. So what I'm going to do is just play this out now. You can see that we go get tagged into that level, and then we go and push to the downside quite nicely there. We can see we've got a clear double bottom here. You know, we have made a previous high. We have taken liquidity from here. So there is actually, you know, a reason to potentially take a buy position in this level. You can see there's liquidity below here, so it makes sense to break the double bottom. And again, we will cover liquidity in this three-part mini series. So don't be too alarmed if that doesn't make sense just yet. So again, there's a very good chance this is going to break the double bottom here, whereas a lot of people will assume that, okay, there's a double bottom there. Naturally, price will probably push to the upside. And we know that that is not always the case. So what we're going to do is just continue to play price action out here. As you can see, we get a bit of a reaction there. Again, that's very natural. There will be people buying at these levels. And what we can see is price continues to push to the downside and break those levels. And then what we can see is price action continues into these lows here. And then we start to slow down a little bit. You know, potentially we could have actually targeted, you know, lows a little bit lower, but just for the sake of the video, you know, we wanted to kind of just take price to those levels really. Now, what we can see as price does push down here, if we look at the overall nature of that price action, we can see that it's very corrective, it's very descending, and that's why we've gone and pushed to the upside. So you can see that that process repeats itself time and time again. So yeah, that's a beautiful example of how that can truly make a difference, from how understanding price is approaching that area, from understanding the previous price action that happened. It really does give you that edge in the market and can avoid you taking those silly little 1% losses and overall improve that strike rate. So let's get on to the last part of this video. Right guys, so now we have our third and final example on this part of the video. Now, looking at this straight away, what can we see? What can you understand from this, having told you what I've already told you, okay? So what can we see? So price action has clearly had an impulse to the downside here. And now what can we see? We're clearly corrective, okay? We're clearly corrective in this pullback. We can see that this is just one big ascending channel. Now, like I've previously said, when we have an impulse, we want an ascending, and then we should continue that push to the downside, okay? So that's what we're looking at. Now, if we jump right down to the hourly time frame here, we'll be able to have a closer look at what happened in order to find the order block. Now, what we can see here is the market pushed up, created this little high, pushed back, created a low, and then pushed the upside to gather liquidity here. We can see that really fast push to the upside. You know, institutions can't hide here. That is clearly institutions pushing price to the upside there in order to kind of, you know, catch people on the wrong side of the market. So what we can see is that's a push up. We've then pushed to the downside and broke our lows. So naturally, again, there's going to be an order block in here. And this is why, again, discretion is so powerful. Is it this order block here? Is it this order block here? Or is it this order block here? Again, discretion is so necessary when trading. It's such a powerful, powerful tool. Now, what we can do with our order blocks is we can trade off the 50% of them, which we have previously talked about. I don't know why I can't get this line straight. There we go. So we can actually trade off the 50% of our order blocks as well. So we know now that we have our clear area of interest in this nice big order block. We have the 50% in the middle. We have corrective price action into that area. So this is now looking very, very good. So if I just play one more candle out, you'll see this, okay? So what we can see is we've now created that second touch at the low of our pattern. As you can see, we're incorporating our patterns into this as well to give you a bit of an insight into how we look at it and how, you know, you can see those clear differences there. So what we can see, we have one touch, two touch, and we will have had our third touch here. And this is typically where we do look to execute our positions within patterns. We do like the third touch. Now, if we drop down onto the hourly time frame, what can we see? So if we'd have this drawn all the way out here, we can see that we would have rejected off that level really nicely, and we could definitely now go and push to the downside. And we'll just start to play out a few more candles. You'll see that we don't really get that commitment to the downside. So what we can do is separate our pattern. So again, we still know the pattern's there, but we can focus on price action that's forming in this area. Now what we can see is price goes and reacts off the 50% there, and then starts to push to the downside again. But as you can see, we just don't get that last little bit of commitment. So what we can do, and what we teach here at TST, is we look at patterns and pattern separation. So again, with trend lines, a lot of people do just treat trend lines as a force field. It's the same with patterns, and they think the second price touches that level, it has to respect it. And we know that's not the case. We know that we use trend lines and patterns as guides. And again, we have to understand that raw price action to decide whether or not to enter at the pattern or let price develop a little bit more before taking that trade. So what we can see here is, again, price action has impulsively pushed up, and we can now see that we're starting to become ascending. So again, like we previously talked about, when we have an impulse up, we want descending price action to continue. If we have an impulse up and we see ascending price action, there's a very good chance we'll reverse. So that's kind of what I'm looking at here. Now, if I just draw on my pattern, you can see here that we have a bit of a rising wedge. And again, this is where you can actually use your understanding of patterns and price action to potentially even getting in tighter than you would just purely trading the order block. So for example, if I was going to trade off the order block here, off the 50%, I'd have to have a 15, 16 pip stop loss, to make sure that price is above the order block there. Now, what I'm going to do is just play it out and kind of show you how I would actually go about it. So now I've seen this, I definitely know that price can pop up here. So again, this sometimes makes sense because what we can see is we have a double top. Again, there's going to be liquidity above this level, which the market can come and grab. And again, that's why we trade patterns, which we'll touch on later on. So as we can see, price pushes to the upside here. Again, we start to react off that double top. Quite naturally, that is going to happen. But then we can see price pushes up here into our area of interest. Then we see price create a nice engulfing candle here. So what we can then do is enter on the close of this candle. And we can literally just bring our stops above here. So we could actually have a 13 pip stop this time. So again, nice and accurate. That's a really, really nice accurate trade there. Nice and protected with our stops. And what we can actually do is now look for a target. Now with our patterns, we know that we have the 90% rule, so we can come and target here. And again, this actually removes a bit of the discretion, because what people do is they tend to kind of create these imaginary levels that they feel price can stop at. And this is where people are tempted to close out their trades. But we actually have areas that we specifically target, and it removes that thought process, that emotion, and that discretion when a trade is running, unless we clearly see something that is going to hinder that. So what we can do is have this as a target. That's going to bring us about 14% there. And then do we have any other levels that we could target as well? Potentially we have, these little lows in here, this level across here. That could be a nice extra little target if we do go and smash through 90%. So if I just start to play this out now, hopefully you'll see how this works. So truly, impulsively to the downside there, which is exactly what we see out of these patterns as well. This is why patterns are so important, because again, this is just a different way to gather liquidity, like I said, but we will touch upon that. And as we can see, price continues to push to the downside here, and then we melt through all this level here. So we could have targeted our lows here for 18%, or potentially we do have lows even further. And again, all we'll simply do is just target lower and lower and lower until price action tells us to do slightly different. And as we can see, price continues to push, and hits our low there. And then if we just continue to play price here, what can we see? Price action starts to become slightly corrective, and then we do go and reverse in the opposite direction. Now, you may argue that this is slightly ascending, but if we jump down onto the smaller time frames there, we have made a new high, and then we are descendingly corrective, and then we create an impulse to the upside. So that was a really, really nice example there. Banking about 24.94%, so pretty much 25% on that trade. And that's purely from using our discretion. Now, what we can do is use our discretion to find these patterns, find these corrections, understand price action, and understand the larger picture. We can then kind of become sort of mechanic by highlighting an order block level. You know, we can use our entries at the bottom, entries at the 50%, you know, to kind of give that systematic approach when we are looking for entries. But yeah, you can just see how important that overall discretion is, and how understanding the price action, understanding where our entry is, understanding there's a pattern there as well to give it that extra strength, understanding that we can target the 90%. If we break the lows, we have our next swing. If we break that, we have our next lows. Again, this all comes from discretion and understanding how the market actually moves. So hopefully that makes sense. Hopefully you can gather some value from that. And now we can get on to the next video. Now, the next video is actually going to be understanding liquidity. And this is a really great video, and I'm sure you're going to enjoy it, guys. So let's get on to that now.